Hi, I'm Tammy Fitchett, your Silicon Valley real estate reporter. And today we're going to discuss the tax bill that just passed and how it may or may not affect us as home buyers, or if you're considering putting your home on the market, a home seller. I found this article in the San Jose Mercury News, and it gives a good synopsis of what we have to look out for concerning this new tax bill and how it may affect us. One thing we do know is that if the proposed real estate deductions could cause the prices in California, the state of California, to drop at least 8 to 12%. This is about $36,000 to $57,000. However, we do have to keep in mind that our market here in Silicon Valley, roughly Santa Clara County, is unlike any other market for the most part in California. It's a very unique market in itself, and it's really hard to be compared to any other market in the state of California. So while prices dropping may sound like a good idea in the Bay Area if you are a buyer, what it can do is, in our area, cause sellers not to put their home on the market. So in a market where we're already short on inventory as of today, December 4th, 2017, we only have 601 homes on the market. 498 of those are single family. The others are townhomes or condos. This could squeeze our market even more. And it could already send these home prices that are already compared to other areas considered high, even higher, because you'll have less inventory. According to Elizabeth Mendenhall, the tax incentives to own a home are baked into the overall value of homes in every state and territory across the country. So when these incentives are taken out in this the way this bill provides, it's shown that home values tend to fall by an average of 10%. However, again, our market's unique because we are already having a squeeze on the market. We don't have a lot of inventory. So as a seller, it could look good for you because there's low supply. So with this in mind, it's not clear what the final tax plan is going to look like as the final version of this is expected to pass right around Christmas. However, there are some other things in here we should consider. Mortgage interest deductions. Under the current law, homeowners can deduct interest on the purchase of up to $1 million. And they can deduct interest on the purchase of up to $1 million extra for equity debt. However, under the new plan, existing mortgages would be grandfathered in, and the new cap would be for mortgages at $500,000. And we know in the Bay Area, it's hard to find. It's almost impossible. We could say it is impossible to find a single family home at about $500,000. Everything is over that. So, in addition to this, homeowners would no longer get a deduction for a secondary residence. So being mindful that last year, 49% of housing units with a mortgage were greater than $500,000, homeowners claimed mortgage interest deductions saved an average of about $3,700. So this is something that we would be facing here. Another thing that we would be facing is capital gains. Just as a reminder of what capital gains is. Capital gains is if you're in your home as a single person, you have up to $250,000. As a married couple, you have up to $500,000 that you can gain without being taxed. That's being in your home at least 2 of the last 4 years. However, under the new plan, what would happen is instead of being in your home 2 of the last 4 years, you would have to be in your home 5 of the last 8. And we know here in the Bay Area, it is very easy to gain equity. So you would have to wait in your home longer to meet the requirements of capital gains. And again, this could put another squeeze on the economy so that people wouldn't be motivated to move because of being taxed. And it would again make our market that's already squeezed even that much tighter. That's less supply and more demand. And that could send prices even higher. Last year, 13% of homeowners in California lived in their home for between 2 and 4 years, meaning they wouldn't be eligible for the tax exclusions. And Bay Area homeowners would be forced to stay put, stand tight where they are instead of selling so that they could take advantage of the capital gains benefit. The next thing, there would be a cap on the property tax deductions at least $10,000. The researchers noted that this is something to keep in mind with this one. Itemized deductions would be reduced under the proposal. Standard tax deductions would be increased. So the current standard deduction is roughly $6,300. This would be increased to $12,000. And if you're married, you have the deduction of $12,000, and this would be increased to $24,000. So in some respects, this could help even out where they're taking away and capping. It can help even it out at the end. So these are things that we have to consider that could affect us with the passing of this new tax bill. Again, so you can read the article yourself and get a clearer understanding. I'm going to put the link to the article in the box below. I would highly advise you to reach out and talk to your CPA should you have any questions. I'm a realtor just telling you what's going on. I'm not a CPA. However, if you do have any real estate related questions regarding the article, please don't hesitate to reach out. I'm putting my contact information in the box below. Otherwise, have a great day, and I'll talk to you again soon.